In the years leading up to 2008, the American housing market appeared stable to most observers. According to historical housing data, home prices had risen steadily for decades. This reinforced the idea that mortgages were low-risk investments. Banks, financial institutions, and investors trusted mortgage-backed securities as reliable instruments for income and diversification. However, a small number of analysts began to notice unusual patterns. One such analyst was Michael Burry, a hedge fund manager and physician-turned-investor. According to public interviews and filings, Burry studied the mortgage market in extraordinary detail. He reviewed thousands of individual loans. He noticed that many mortgages were risky, with low documentation and adjustable rates. Borrowers might default once introductory payments increased. While the broader market assumed stability, Burry calculated that defaults could rise dramatically if home prices fell. He focused on mortgage-backed securities and credit default swaps. These instruments could profit if defaults occurred. This was unconventional. Most investors continue to trust ratings and historical trends. Burry's analysis was methodical and data-driven. He did not speculate on intent, emotion, or conspiracy. He focused only on documented patterns, repayment histories, and risk models. According to court filings and financial reports, he began positioning his hedge fund to benefit from potential defaults using credit default swaps. This move attracted skepticism. Banks, partners, and even some investors were uneasy. Mortgage-backed securities were still considered highly rated and safe by traditional standards. Burry's work demonstrated the limitations of ratings and models when systemic assumptions were flawed. By 2005 and 2006, he noticed early delinquencies rising in certain mortgage categories. These included subprime adjustable rate loans. According to public records, these early warning signs were visible but isolated. Most institutions considered them minor and manageable. Burry's models, however, projected broader consequences if price declines spread regionally and nationally. He communicated his findings carefully to investors, emphasizing the data and potential outcomes. Despite skepticism, he continued building positions that would profit if defaults increased. His actions were not speculative or reckless. They were based on analysis of documented risk factors. During this period, many investors continued to follow conventional wisdom. A-rated securities dominated portfolios. Analysts relied on historical trends. Confidence in housing remained high. The contrast between Burry's research and mainstream belief illustrates the importance of independent data analysis. According to regulatory and financial records, the early stages of the housing slowdown went largely unnoticed by the market. By 2007, early signs became harder to ignore. Housing prices began to fall in multiple regions. Borrowers with adjustable-rate mortgages faced higher payments than they could afford. Defaults increased in scope and severity. Credit rating agencies, once confident in their models, began downgrading securities. According to filings, some institutions were forced to reassess their portfolios, selling assets under pressure. This created a feedback loop. Declining prices caused more defaults, which led to more sales, further pressuring the market. Financial institutions that were heavily exposed to mortgage-backed securities faced substantial losses. Short-term funding markets froze for some banks. Liquidity problems emerged. Michael Burry's hedge fund, which had positioned for rising defaults, began to generate significant returns as these events unfolded. According to investor reports, his analysis accurately reflected the emerging systemic risk. At the same time, most of the market had not internalized the severity of the situation. Burry's story demonstrates how careful, data-driven research can identify risks missed by broader consensus. His work highlights the limits of conventional assumptions and the importance of stress-testing financial systems. The consequences of the housing crisis were widespread. According to post-crisis reviews, millions of households faced financial hardship. Retirement funds, municipal investments, and insurance companies were affected. Global financial markets experienced volatility. Governments intervened with emergency funding for major institutions. This story also illustrates a broader lesson for risk management and economics. Even when a single analyst identifies risk using documented methods, market consensus and prevailing assumptions may delay recognition. Confidence and trust in historical trends can obscure underlying vulnerabilities. Educational reviews of these events are now standard in finance programs worldwide. Financial instruments, data analysis, and systemic risk are taught using this case study. It demonstrates how independent analysis, careful documentation, and empirical research can provide insights overlooked by the majority. While the events of the 2008 financial crisis were complex, they were ultimately traceable to documented patterns in lending, risk assessment, and market structure. Michael Burry's role was one of careful observation and application of financial analysis. No speculation is needed to understand his contribution. The documented data supports the outcome. This is a case study in the importance of questioning assumptions and relying on data, especially when markets appear safe. Full documented story on the channel.